So you want to own a shopping mall. You buy a giant building, you fill it with stores, and every one of those stores hands you a rent check every single month just for the privilege of being inside. Thousands of shoppers wander past those shops every day, and the whole place runs itself while the money piles up in your account. It looks like the easiest real estate on earth. One building, 100 tenants, 100 rent checks. Now here's what should give you pause. A mall can be more than 90% full and still be quietly going broke. And the most expensive shopping mall ever built in America, a $5 billion palace outside New York with an indoor ski slope and a theme park inside it, has spent years missing payments on its debt while its doors were wide open and its parking lot was full. In this business, a busy mall and a healthy mall are not the same thing, and telling them apart is the entire game. By the end of this, you'll understand why a full building can still bleed money, why one tenant leaving can pull the floor out from under 100 others, and what a mall is actually selling once you look past the food court. Because a mall is not a building full of stores. It's a machine that manufactures foot traffic and sells it by the square foot. The big anchor stores at the ends, the department stores, are paid in absurdly cheap rent to pull a crowd through the doors. The small shops in the middle then pay premium rent for the right to stand in the path of that crowd. Own the machine, and you're not really a retailer at all. You're a toll collector on human movement, and the moment that movement stops, everything you built on top of it starts to fall apart. Let's start with what you're actually buying, because not all malls are the same animal. In the United States, there are roughly 1,100 shopping malls, but only around 300 of them are what the industry calls Class A, the top tier, with luxury tenants, low vacancy, heavy foot traffic, and a location near money. Those trade for enormous sums because the income they throw off is stable and predictable. The other 800 or so slide down through B and C grades to the Walking Dead, and some of those have sold for a tiny fraction of what it cost to build them. So the price tag on a mall isn't really telling you about a building. It's telling you which bet you're making on the town around it. And most malls today aren't owned the way you'd own a house. They're owned through a real estate investment trust, a REIT, a company that holds income-producing property and is legally required to hand almost all its profit to shareholders every year in exchange for skipping corporate income tax. This is why you can own a slice of a mall empire from your phone for the price of a coffee, without ever dealing with a leaking roof. And one company sits on top of the whole industry, Simon Property Group, the largest mall owner in the country, with stakes in more than 200 properties and tens of billions of dollars in market value. Simon owns 26 of the 46 best malls in America. A dozen of its individual properties each throw off more than $100 million in net operating income every year. Its occupancy sits above 96%. That's the top of this business. And it looks nothing like the dead mall 2 towns over with plywood on the storefronts. And through the exact stretch that killed the weak malls, Simon's market value roughly tripled from about $20 billion to the high tens of billions. That's the pattern of this whole industry in one line. The strong malls got stronger, while the weak ones got boarded up. So how does a mall actually make money? It comes in layers, and the layers are stranger than they look. The first layer is base rent, a fixed amount per square foot per year that every store pays for its space. At a strong mall, a small inline store might pay somewhere around $50 or $60 per square foot. But the department store anchor, the one with the biggest sign and the most floor space, often pays a tiny fraction of that, sometimes just a few dollars a foot. Why would any landlord accept that? Because the anchor isn't really paying for space, it's paying with its name. The anchor drags customers into the building, and those customers walk past dozens of small shops on the way in and out. So the mall rents cheap square footage to the anchor and charges everyone else full price to stand near it. Every little store in that building is quietly subsidizing the anchor's discount. The inline stores are the real rent payers. The anchor is the bait. The second layer is percentage rent. On top of base rent, many stores agree that if their annual sales cross a certain line, the break point, the mall takes a small cut of everything sold above it. So when a tenant has a great year, the landlord automatically shares in the upside without lifting a finger. The third layer is the one nobody outside the industry thinks about: common area maintenance, or CAM. This is separate from rent. It's the tenants collectively paying to run the building itself, cleaning the floors, lighting the corridors, maintaining the parking lot, running security, keeping the escalators moving. Each store pays a share based on how much space it occupies, which means a big chunk of what it costs to physically operate the mall isn't paid by the owner at all. It's billed straight back to the tenants. And then there's everything that isn't a store. The kiosks in the middle of the walkway that pay eye-watering rent per square foot because they sit exactly where foot traffic is heaviest, the advertising on every screen and banner, the pop-up holiday markets, the parking. For some malls, those add up to a meaningful slice of the whole. So far, the mall sounds like a machine that prints money from four directions at once. Now the trap. Remember that a mall can be 90% full and still lose money. Here's the mechanism. Occupancy is not the same thing as income. If half of your occupied space is anchor stores paying almost nothing, and a growing share of your small shops are on discounted short-term leases just to keep the lights on, then the building can look healthy from the parking lot while the actual cash flow is collapsing. A full-looking mall can be financially hollow. And CAM, that clever system where tenants pay to run the building, hides a death spiral. Those shared costs don't shrink when stores leave. The empty corridors still need cleaning. The lights above a dark storefront still need power. Security still has to patrol the whole building. So when vacancy rises, that same fixed pool of costs gets divided among fewer paying tenants, which means every remaining store's CAM bill goes up, even though nothing about the building's upkeep has changed. Rising vacancy doesn't just cost you the rent from the empty shops, it quietly raises the cost of staying for every store that's still open, which pushes the next marginal tenant toward the exit, and so on. Then there's the clause buried in almost every mall lease that turns one problem into 10. It's called co-tenancy. In plain terms, if a major anchor closes, the smaller stores around it are contractually allowed to pay reduced rent or in some cases walk away from their leases entirely. You don't feel this cost on the day you buy the mall. You feel it the day your anchor leaves, because suddenly a dozen other tenants are legally entitled to pay you less, or nothing at all, for reasons written into contracts years before you owned the place. And refilling an empty anchor is neither fast nor cheap. These boxes were built for one kind of tenant, a single store spanning 100,000 square feet or more, with loading docks and a layout that converts into almost nothing else. When the mall owner Masaryk set out to redevelop just one former department store at a Brooklyn mall, it spent $100 million over 3 years to subdivide that single box into 4 smaller stores. One box, 3 years, $100 million. Now imagine dozens of empty anchors landing on the industry at the same time, which is exactly what happened. For most of the 20th century, department stores like Sears were the backbone of the American mall. Developers often wouldn't break ground until they had 1 or 2 signed as anchors because banks wouldn't lend without that guaranteed foot traffic. Then, in October 2018, Sears filed for bankruptcy. At the time, it had hundreds of stores sitting inside malls across the country. Simon Property Group alone had Sears in dozens of its properties, and because of those co-tenancy clauses, each closure didn't just remove one anchor's token rent. It threatened to trigger a wave of rent reductions and lease exits throughout the entire mall, all at once, all from contract language written back when everyone assumed the anchor would stay forever. One tenant leaving could reprice the whole building. Mall owners fought back in ways that revealed just how dependent they really were. When Penney went bankrupt in 2020, 2 of the biggest mall landlords, Simon and Brookfield, bought the retailer out of bankruptcy themselves for around $1.75 billion. Sit with that. The landlords bought the store at enormous cost, largely to keep the boxes lit and stop the co-tenancy dominoes from toppling across their own malls. When your survival leans this hard on a single tenant, you'll buy the tenant outright just to stop it from dying. That's the structural truth underneath this entire business. A mall doesn't fail because business is bad everywhere. It fails because one big piece falls out and the rest of the structure was quietly built to depend on that piece staying in place. It's a single, interconnected financial organism wearing the costume of 100 independent shops. The Sears collapse didn't happen in a vacuum either. It hit at exactly the moment online shopping was eating retail alive, and this is the part that actually explains the death of the American mall. For decades, a mall's real product wasn't the stores inside it, it was convenience. If you wanted to compare 5 brands of shoes in one afternoon, the mall was the only place in town that let you do it in a single trip. Online shopping vaporized that advantage overnight. Now you can compare hundreds of options from your couch and have them at your door in a day. The mall's original reason to exist, convenience, simply stopped being unique to malls, and the ones caught in the middle got crushed. Not upscale enough to sell an experience you couldn't get online, not cheap enough to win on price alone. To see how badly this can go, even with the deepest pockets, look at the most expensive mall ever built in America. American Dream in East Rutherford, New Jersey, was meant to be the future of the shopping center. 3 million square feet stuffed with a theme park, a water park, an indoor ski slope, and hundreds of stores. It cost around $5 billion. It took the better part of 2 decades and multiple owners to finally open in October 2019, and then the pandemic shut it down months later. It was financed in part with more than $1 billion of municipal bonds, and it has spent years since missing payments on that debt, draining reserve accounts down to a few $100s and reporting losses in the tens of millions. This isn't a dusty old mall in a shrinking town. It's the newest, most expensive, most ambitious mall in the country, and the math still hasn't worked. A full building and a solvent building, again, are not the same thing. So let's add it all up and answer the real question. What do you actually make if you own a mall? In the good version, you own a Class A property in a wealthy, growing area, with strong anchors that still pull real traffic, a healthy mix of restaurants and services alongside the shops, and low vacancy. In that case, base rent, percentage rent, and CAM reimbursements produce steady, predictable income month after month, and the property holds or gains value as long as the neighborhood keeps growing. This is the outcome that turned mall REITs into some of the largest real estate companies on the stock market. A dozen single properties, each earning north of $100 million a year. In the realistic bad version, a single anchor closes, co-tenancy clauses trigger. A handful of small tenants cut their rent or walk when their leases end. The empty anchor box sits there for 2 years generating nothing while still needing to be secured, insured, and maintained. And the fixed CAM pool now spreads across fewer paying tenants, so even the loyal stores are quietly paying more to keep the lights on in hallways that see less traffic every month. The difference between those two outcomes for the same building can be the gap between a growing asset and a slow slide into the dead mall column, and almost none of it shows up as a dramatic event. Just a slightly higher vacancy, a slightly heavier CAM bill, a slightly slower month, compounding quietly until the number at the bottom looks nothing like the plan. The owners who survive figured out the one thing that actually saves a mall. They stopped selling products and started selling reasons to physically leave the house. The strongest operators are now filling old anchor boxes with the things a screen can't deliver. Restaurants, gyms, medical clinics, entertainment venues, and in many cases apartments, hotels, and offices layered right on top of the retail. Simon now spends hundreds of millions a year turning tired malls into what one analyst called a retail theme park. A mall used to sell you things. The malls that survive now sell you a reason to be there. So if you ever do decide to buy a shopping mall, remember what you're actually buying. It looks like a building full of stores. It's really a single, tightly wired financial system where every tenant's survival is quietly tied to every other tenant's survival. The anchor doesn't just sell clothing. It sells the foot traffic that every smaller store depends on to breathe. And when it leaves, it doesn't just leave a hole in the floor plan. It pulls the financial floor out from under everyone standing near it. The building was never the business. The crowd walking through it was. And if this pattern is starting to feel familiar, a business that looks like a money-printing machine from the street and turns out to be a survival fight underneath, you've seen it before on this channel. Watch the one on owning a casino next, where the math guarantees a profit on every single bet and the owners still go bankrupt. Then the one on owning an airport, where the busiest hub in Europe quietly loses money on the planes. It's the same trap wearing a different building every time.